Andrew, I was surprised to find sizable inflows into bond funds. Corporate, I saw government, even high yield. I don't normally cover a lot of inflows because it's hard to figure out what it means, but it did stick out to me, given that we saw outflows in bond funds for a good part of the year. Does this mean anything, these inflows we've been seeing in bond funds?
Well, I think it was cash. I mean, there's been any selling at all, it's been short term, and that's basically cash right? If you're in BIL ETF, you're basically in cash, right, with like a little bit of a kicker. So it's been people dipping their toes into the water. You're coming out of, or what's going to be a U-shaped recovery, I believe. It might already be, if you compare it to COVID, which was a clear V. So the money that's flowing into TLT and GOVT, $9 billion. $6 billion into HYG and J&K. So I think the real move is institutional investors starting with bonds to play the recovery. Eventually they'll move on equities.
So, I'm wondering, Ben, your thoughts on this, your thoughts on bond inflows and what they meant. I'm not sure historically if it's worth covering this in an in-depth manner, but I saw inflows into Treasury Bonds, LQD, which is the corporate bond ETF, had inflows. J&K, Spider High Yield, USHY, which is the iShares High Yield Corporate, all had nice inflows this month. Does it mean anything?
Well, it in part shows a lack of consensus. In part, it also shows or could be masking just the dominance of the ETF structure. We've seen significant outflows out of bond mutual funds and inflows across the board into ETFs. So there's a little bit of a structural play there. But Bob, as you said, we've seen flows coming into different parts of this to this market. More recently we've seen flows come in the longer end of the curve, which is actually pretty interesting, and maybe not quite as significant or on top of the leaderboard, but certainly actively managed fixed income is starting to attract more attention, where at least certain retail investors and maybe to some degree some professionals as well are just saying, look, I'll leave it to an actively managed product or professionals to handle it at this point in the market. So a little bit of everything.
Yes, by longer term, you mean 20 and 30-year bonds, I gather. Now, in contrast to bond flows, Ben, flows into equity ETF. Now, you tell me, you're the expert. It seems kind of flattish to me. There's some flows into growth funds, maybe some outflows from value, but it doesn't seem titanic to me. And you also highlighted, I asked you about this, money into high dividend ETFs like SPHD. So what are you seeing here in equity flows? Everybody always wants to know what's going on the equity side.
Of course. I mean, again, there's somewhat of a lack of conviction or consensus here with regard to the flow. But yes, we're seeing investor interest into dividend ETFs, which haven't, been out of style, for over time. But more recently, we've seen an uptick. SPHD is a good example of a product that really kind of sums up where investors are at. I would say it's a way to play this market more defensively, but also try to collect some income in a way that really avoids, I guess, some of the risk or the perceived risk in the bond market. And we also see in our book at BNY Mellon, really issuers lining up for these type of products. Some of them are passive, dividend oriented. Others are just different types of actively managed ETFs, trying in some way to provide a similar type of return stream for their investors.
And high dividend, low volatility, SPHD, of course, has consumer staples, utilities.
Yeah, it's actually a defensive play if you're going to be in equities.